The selling in today's market is showing us that there might be a little bit of sogginess starting to come in. We had a bearish engulfing signal in the Dow, and we had a bearish engulfing signal in the NASDAQ. So you can see right in this area, we're starting to see some resistance. Although we have not closed below the T-line on the indexes, it's showing there might be some weakness in here. And that's probably due to the fact that this market may need a rest after a nice long uptrend. There's nothing that is going to add any more stimulus now that the tax bill looks like it can get through. Now the evidence of a bullish economy is going to have to come from what is actually happening out there with future earnings reports, etc. When the market gets a little bit soggy, it becomes much more apparent that candlestick patterns work extremely effectively because they're usually not going to be offset or influenced by the overall market trend. As we can see on our recommendation from a J-hook pattern in the overstock, it actually traded up after consolidating today, continuing this J-hook pattern that started with kind of a trend kicker gap up through the T-line after a bullish engulfing signal right off the 50-day moving average. That continues our uptrend, and the reason for that is a pattern usually takes a while to develop. It's an accumulation of investor sentiment over time. So a couple of days of pullback in the market is usually not going to offset that investor sentiment that's been building up. So there's two benefits that occur coming out of a candlestick pattern. Usually the percent return is much greater, much more than what you would see in a slow trending stock during a slow trending up market. And when the market turns, it may take an extra day or two for a pattern to start rolling over, giving you much more time to take profits or get out of a position. So being able to identify a pattern such as a fry pan bottom in RFP becomes a much greater prospect of not only being in an uptrend, but being in a very strong uptrend, maybe of the same magnitude. Candlestick analysis is merely the graphics of showing us what's happening in investor sentiment. As we can see in this chart, today when the market was selling off, they were still taking this one up based upon the pattern. It can still be a strong buy on positive trading tomorrow, telling us that this area is not acting as resistance. There's more upside. And being able to identify when the markets are getting a little bit soggy tells us that we don't want to be 100% long, that you probably want to have a few short positions in the portfolio. And if we can recognize the strongest sell signals, such as our recommendation to go short on AXDX today, was based upon the alert from yesterday, where after being in a potential J-hook pattern, they gapped down below the previous day's low and did a doji. That is exactly what you don't want to see if you're on a bullish chart. Secondly, the fact that they gapped it down and did a doji allows the candlestick investor to be prepared to be in a highly profitable trade, in the sense that we know what the simple rule of the doji is. They're usually going to move in the direction of how they start trading after a doji, thus creating a bearish flutter kicker, which is essentially that if you took out this little flutter, you've got a bearish kicker signal, which is one of your strongest sell signals, making the analysis of where the next target will be that much more logical. So the graphics of candlesticks merely indicate what's happening in investor sentiment. So when you start adding up the prospect of analyzing what the overall market is doing and then being able to identify where the strongest bullish or bearish chart patterns are, you're always putting yourself in a situation where you're in probably the high probability trade setup. That'll be it. We'll see you in the chat rooms.